Hi everyone, this is the next video for the week. What we're looking at in this video is something that we call monetary policy. Monetary policy is also another example of a demand side policy. So another tool that we can use to influence the level of aggregate demand in the economy. So fiscal policy is a demand side policy, and so is monetary policy. Now, before we get to monetary policy, I want to think about two different key terms. Understanding monetary policy really requires you to understand these two different key terms really well. Now, first of all, interest rate. This is something that people think they understand, but often they don't. Now, monetary policy, when you look at the word monetary, we're looking at money. When you give something a monetary value, you're looking at it, what is it worth in pounds and pence? So monetary, think about it as money. Now the interest rate is the value of money. This is what money is worth ultimately. Now think about why the interest rate is the value of money. Interest rates, it's the percentage returns available to savers, but also the percentage cost of borrowing. So if you shove your money in the bank will pay you an interest rate. So you stick in £1,000 in the bank, you might get, if you're lucky, 1% interest across the year. So that will give you roughly £10 interest at the end of the year compared to the start of the year. Now the banks will make profit on that money by taking your £1,000 and lending it out to other people across the economy. That could be to buy houses, to take out loans, credit cards, buy government bonds, and the idea is that banks will hopefully generate a higher interest rate on that money. They take that money back, and that is used to give you your interest. So the interest that you get on your savings is generated by the banks working your money hard, investing it on your behalf to make returns. Out of them returns they make, they'll keep some profit, and they'll pay you your interest into your bank account. Now, the reason why I say interest rate is the value of money. Think about it like this. If you want to borrow money that you don't own, if you want to borrow from a bank, you've got to pay an interest. So on my mortgage, for example, I had to borrow over £100,000. So annually, I have to pay interest on that. So to access that money, demands that cash, I had to pay an interest. If you take out a loan from the bank to pay for a new car, well, to demand that money, you've got to pay an interest. That is the value or the cost of that money. Another way of thinking about it is that if you spend your own savings, you are sacrificing the interest that you could have had by keeping that money in the bank. So think about what it means that if you were to raise interest rates, it means that money has become more expensive. So the logic will now be that if you keep your money in the bank, you're going to get a higher interest rate. So if you spend it, you're sacrificing a bigger interest on your savings. It should make you want to save rather than spend your money. If it's more expensive to borrow money, the money you want to demand is going to cost you more. So the monthly repayments on mortgages and cars will become more expensive. So again, people would want to demand less money. If you lowered interest rates, it means money's cheaper. People can borrow for cheap interest rates and money's cheap. People borrow more to fuel more spending across the economy. So when you think about it, interest rates are quite a useful tool to influence demand. If you were to raise interest rates, money's more expensive, people demand less of it. That could lead to lower consumption and investment taking place. If you were to lower interest rates, money's cheap, people can borrow cheap, they're not getting much interest. That should lead to higher consumption and investment. Now, another really important key term is liquidity. What we're looking at here is what we call liquid assets. So we're looking here of people's access to money, liquidity. Now, at the moment, lots of big businesses are making big losses, and they're asking the government to bail out, governments to give them money to keep them going. And people are saying, well, hang on, these businesses are owned by billionaires. But the problem is these billionaires haven't got billions of pounds sat in the bank. All their money is tied up. It's tied up in assets which are not liquid. And that means they can't quickly access money. So liquidity is a really, really important concept to people's ability to access money. Okay, now what you could argue is if everybody was to walk into a bank and all try to withdraw their savings from the bank wouldn't have enough money. They would have not enough liquidity to be able to pay everyone their money back. So what we'll do when we start thinking about monetary policy, these two key words will become really, really important. So monetary policy. Now, a first important thing to say, monetary policy is not controlled by the government. The people responsible for monetary policy are normally the central banks within an economy. Now, a central bank, if you like, is the bank within your economy that's responsible for lending to banks across the country. They can often manage the government's finances. They will issue notes and currency and manage the money supply across our economy. So in the UK, our central bank is the Bank of England. So they're responsible for the money across our economy, the interest rates in our economy, but they also ensure that our banks have got good liquidity. So if our banks struggle to get hold of money, the Bank of England will be what we call the lender of last resort. They will in effect lend banks money to ensure that banks remain liquid. Right, so the Bank of England, which is based in London in the UK economy, has got independence for monetary policy across our economy. Now they have been given a key target by the government. It's the Bank of England's job to manage what we call price stability. Okay, now price stability, remember, is where inflation is running at 2%. Now, in particular, within the Bank of England, we have a committee that we call the Monetary Policy Committee. Now, what the Bank of England or the Monetary Policy Committee will be responsible for is achieving inflation of 2%. So every month, we get an announcement of what the inflation rate is running at. And if inflation is above 2%, the Monetary Policy Committee will look at what do we do? What can we do to bring down that rate of inflation? If inflation is too low, again, what are they going to try and tackle that inflation rate? Now, normally, monetary policy is looking towards the future. They're not looking necessarily what inflation will be today, but what will it be in 12 months' time? So when they look at their policy, they're trying to think about what could do to make sure that in the long run, inflation remains as close to 2% as possible. Right now, they've got different tools available for monetary policy, and what we've got to be understanding through this for today are interest rates and money supply. Now, in a later video, we will be bringing in exchange rates into this as well, but for now, we're thinking about interest rates, which is the value of money, the cost of borrowing or the returns on savings, but we're also looking at the money supply, which is the amount of money circulating across our economy. Right, now the key interest rate that the Bank of England control is something that we call the base interest rate. Now the base interest rate, there's a few different ways of thinking about this. This is often regarded as the interest rate that the Bank of England would lend to commercial banks for. So commercial banks are your high street banks, your Lloyds, your TSBs, those types of things, HSBCs. So remember, the Bank of England is the lender of last resort. If banks need money, they can go to the Bank of England, and to borrow that money they would pay the base interest rate. But also the base interest rate is often seen as the interest rate that commercial banks will be offered for depositing their savings within the Bank of England. So the base interest rate, to think about it, is the Bank of England interest rate. It's the interest rate offered or charged by our central bank. Right, now another key word here, and this is now linked to money supply. A really, really important key term that we have in our economy is something that we call quantitative easing. Now this is something that's getting more and more popular across the economy, especially when things aren't going very well. Now the logic here is, what we're trying to do with quantitative easing is to expand the supply of money across the economy. Think about it logically. If you wanted to push up economic growth, If you can push more money into the economy, there's more money for people to access, and that should spearhead lots and lots of consumption and investment to take place. Now, we could do this in quite a fun way. We could literally just print loads of money and drop it down on people, so there you go spend it, or just deposit lots and lots of money in people's bank accounts. Now, we don't do that. The logic will be that what the Bank of England will do, remember they're responsible for money supply, they will create digital money. So they will create lots of fake money on a computer screen. They will then use this money to buy lots and lots of government bonds and corporate bonds. So remember, government bonds is borrowing to the government. So lots and lots of big financial firms will lend to the government. Well, think about it. If the government have got all the money, then there's no funds available for you and me to borrow, to spend or to borrow. But also we have corporate bonds. Now, some big businesses will often create bonds as well, and that means that big financial firms like banks will often buy these corporate bonds. Now, what the central bank will do, then they will use lots of money they've created to go across the economy and buy lots and lots of these different bonds. Now, what that does, in effect, because the government, the Bank of England are now buying all these bonds, it means that financial firms no longer own these bonds. And that means that financial firms like banks have got more money pushed back into their vaults. So it means that banks have now got more money available. Their liquidity is improved. Now, because banks have got more money available in their vaults, they've got more funds available to lend to households and firms. So it means that more of us can borrow more money across the economy. So it's a really, really clever way of pushing more money back into the economy. Now, another way of thinking about it as well, if you were to, that's my coffee machine going on by the way, if you were to increase the supply of anything, its price goes down. Bigger supply, prices start to fall. If the Bank of England creates additional money, they've increased the supply of money. Now, what this will then do, it will mean that interest rates start to fall across the economy. And if interest rates are lower, more of us will borrow more money, households and firms, because money's now cheaper. Less of us want to save. And it's a clever way of getting people spending more money in the economy. So quantitative easing, everyone. We create fake money. We then use that to buy lots and lots of different government and corporate bonds. That will then push more money back into the financial system, which means there's more funds available for you and me to borrow money. If it helps everyone, just think about it as quantitative easing is about increasing the supply of money. Right, that's the complex stuff done. This bit is fairly straightforward. Right, everyone, now what we've got here then, we've got how we can use monetary policy to influence aggregate demand in the economy. Right, now what I've gone for here is a classical LRAS curve. Remember, YFO is the potential of the economy. Now here, the economy is operating in a positive output gap. Now when you're in a positive output gap, it means that actual output is bigger than potential output. And what this will mean is the economy's got lots and lots of scarcity, and that will mean you've got really, really high rates of inflation. So what you want to do now is to bring down aggregate demand. Now we could use deflationary fiscal policy by lowering government spending and raising taxes, but what we can also do is to use deflationary monetary policy. So what we would do here, we would raise interest rates. If you were to raise interest rates, so the logic would be if you raise the base rate of interest, banks across the economy will raise their own interest rates too. And if interest rates are higher to borrow money, it means that the price of money, the value of money is increased. It's more expensive to borrow money. So people start to demand less loans from banks, less mortgages, etc. Businesses borrow less. And this will bring down consumption and investment, which will ease inflationary pressures in the economy. Now, a really, really important thing to think about here is so the impact on mortgage owners. Some people have what we call a tracker rate or a variable rate mortgage deal. And the logic will be that their mortgage will follow the Bank of England base rate. So if the central bank were to raise their interest rates, it will mean that people's interest rates on their mortgages start to become more expensive. And that will mean their monthly repayments increase. That means that disposable income starts to fall and again would lower consumption. So higher interest rates mean that those with variable and tracker rate mortgages will spend more on their mortgages, which means they can buy less output across the economy, and people are less wanting to borrow money. But also what higher interest rates will do, it would raise the attractiveness of savings. By spending your money, you are sacrificing the interest rates on your savings. So higher interest rates will make people want to save and spend less. If people are saving more, you've got more of a withdrawal from the economy, and that will bring down aggregate demand. Now what you can also do is to reduce the money supply. So through quantitative easing, you've got the Bank of England expanding the money supply. Or we can do it in reverse. The government could now start to sell those government bonds or corporate bonds that they own, and then people will buy them. And as people start to buy them, big financial firms, for example, it means the central bank have got more money back in the central bank, and they don't release it back into the economy. So if you reduce the money supply, money becomes scarcer, and if money becomes scarcer, it becomes more expensive, and that will also lead to higher interest rates, which will bring down aggregate demand. Now, expansionary monetary policy is just the opposite, really. You've got here a negative output gap. So in this diagram at the bottom, the economy is operating below its potential. Actual output is below potential output. So this time we want to boost aggregate demand to tackle normally potential deflation or disinflation. We've got to raise inflation back up towards 2%. Create jobs, tackle that spare capacity problem. So what you would do here, you'd be looking to lower interest rates. Now if you were to lower, pains knackered, the interest rate, it means that money's cheaper. People will borrow more, which means you're going to get more consumption, more investment taking place. Mortgages become cheaper, so those with variable rate mortgages or tracker mortgages will see repayments start to fall, which will raise disposable incomes and create more consumption investments. But also what you can do, you can raise the money supply. And this was the idea of quantitative easing. If you shove more money back into the economy from the central bank, it means there's more money available for people to borrow and spend, which will again boost aggregate demand. So everyone, like fiscal policy, monetary policy is another demand side policy. Deflationary monetary policy, you whack up interest rates and or you lower the money supply to bring down aggregate demand. If you want to use expansionary monetary policy, you're trying to tackle a negative output gap. Lower interest rates or higher money supply will boost aggregate demand up, creates a bit of inflation, which is good if it's moving it towards 2%, prevents that deflation problem we might be running the risk of, but it also tackles that spare capacity in the economy. So guys, overall, both fiscal and monetary policy are fairly effective tools at tackling both positive and negative output gaps. Now, there are a few problems though. There were problems with fiscal policy. There are also problems with monetary policy. Look at these. Just because the base rate is lowered to try and boost aggregate demand, there's no guarantee that banks will always pass it on. So, for example, just because interest rates have been reduced by the Bank of England, banks might be thinking, you know what, we're going to keep our interest rates higher. We'll just raise our profits instead. And that will prevent the benefits of more consumption investment happening. Now, you've also got to think about animal spirits as well. Right now, for example, interest rates are running at a record low of 0.1%. But then you're reading in the newspapers, GDP could fall by record levels. Unemployment's starting to increase. British Airways announced today 12,000 jobs could be at stake. Well, just because you've got lower interest rates, it doesn't mean that people are confident enough to borrow money. Would, for example, people that are worried about job security go and buy a house on a mortgage? Would people go and borrow £20,000 to pay for a new car if they're worried about job security? So lower interest rates might not always lead to people spending more money in the economy. Savings might still be popular because people might want that money to tie them over if they do lose their jobs. So there's no guarantee again that this would lead to more consumption and investment. My wife's company at the moment, their profits are falling. They were thinking about investing some money back into their capital. Well, there's no way at the moment they're going to borrow more money, even with low interest rates, due to the risk of the business failing in the next few months or so. Now you've also got time lags, and this is linked to habitual behaviour. Just because you've got lower interest rates doesn't mean that people will always respond as you want them to. It might take people a few months to realise that interest rates have fallen, or to adjust their spending habits to take into account those lower interest rates. So again, a bit like fiscal policy, you have got a bit of a time lag. So guys, problems of monetary policy: will banks pass on the interest rate savings? Not guaranteed. Animal spirits: do people have the confidence to borrow even at low interest rates? And time lags: habitual behaviour. People need time to adjust to changes in interest rates across the economy. Right guys, there you go. That is monetary policy.